Preparing for a FP&A Analyst at L'Oreal interview, you've reached Candy Mentor and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like and share, and drop a topic request in the comments. Question 1. What does FP&A do and how would you add value as an analyst at L'Oreal? FP&A connects financial information with business decisions. As an analyst at L'Oreal, I would support budgeting, rolling forecasts, monthly reporting, and variance analysis while partnering with brand, sales, supply chain, and finance teams. My value would come from producing accurate analysis, identifying the drivers behind performance, and turning findings into practical recommendations. In a fast-moving beauty business, I would also highlight risks early, improve reporting efficiency, and help managers allocate resources toward profitable growth. While answering, focus on planning, forecasting, performance analysis, management reporting, decision support, data quality, and translating financial results into commercial actions across L'Oreal's brands and markets. Question 2. Why do you want to work in FP&A at L'Oreal? I am attracted to L'Oreal because it combines global scale with a highly diverse brand portfolio, from mass-market products to luxury and professional beauty. That creates interesting FP&A questions around pricing, innovation, channel mix, marketing investment, and regional performance. I also like that the role sits close to the business rather than focusing only on historical reporting. I would be excited to use financial analysis to support sustainable growth while learning how a leading consumer company manages complexity. Make sure to cover L'Oreal's global beauty portfolio, innovation, brand diversity, consumer focus, commercial complexity, and why FP&A provides exposure to both financial analysis and operational decision-making. Question 3. What is the difference between a budget, a forecast, and a long-range plan? A budget is an approved financial plan for a defined period, usually creating targets for revenue, costs, and investment. A forecast is management's latest estimate of expected results, updated as actual performance and market conditions change. A long-range plan looks further ahead and connects financial outcomes with strategic priorities such as growth, innovation, and market expansion. At L'Oreal, I would use the budget to measure accountability, the forecast to guide decisions, and the long-range plan to test strategic direction. In your answer, distinguish fixed targets from updated expectations and strategic planning horizons, then explain how each process supports accountability, resource allocation, and performance management. Question 4. How would you perform a monthly budget versus actual variance analysis? I would begin by reconciling actual results to the general ledger and confirming that the budget uses consistent definitions and periods. Then I would quantify material variances and break them into drivers such as volume, price, mix, timing, foreign exchange, or one-time items. I would discuss the explanations with budget owners, challenge unsupported assumptions, and assess whether the issue affects the full-year outlook. Finally, I would present concise conclusions, risks, and recommended actions to management. Be sure to mention validating data, quantifying variances, separating price, volume, mix, timing, and one-off effects, confirming explanations with owners, and communicating actions rather than merely reporting differences. Question 5. Which financial statements and metrics would you monitor in an FP&A role? I would monitor the income statement for sales growth, gross margin, marketing investment, operating expenses, and operating profit. The balance sheet would help me track inventory, receivables, payables, and working capital, while the cash flow statement shows how earnings convert into cash. I would also follow operational metrics such as units, average selling price, channel mix, market share, promotional effectiveness, and new product contribution. Together, these measures reveal both performance and the quality of growth. Focus on the income statement, balance sheet, cash flow statement, working capital, profitability, growth, operating expenses, free cash flow, and business-specific commercial indicators relevant to beauty products. Question 6. How would you build a sales forecast for a L'Oreal product category? I would start with historical sales by brand, category, channel, and market, separating underlying demand from unusual promotions or supply constraints. I would then layer in seasonality, distribution changes, price increases, promotional plans, product launches, market growth, and sales team assumptions. I would compare the statistical baseline with bottom-up commercial input, challenge major differences, and create sensitivities for volume, price, and launch timing. The final forecast should be transparent, driver-based, and easy to update. Talk about historical trends, baseline demand, seasonality, distribution, pricing, promotions, launches, market growth, channel assumptions, commercial input, and sensitivity analysis around key uncertainties. Question 7. What factors can cause gross margin to change, and how would you analyze them? Gross margin can move because of pricing, product mix, promotions, raw material costs, manufacturing efficiency, freight, foreign exchange, or changes in channel and geography. I would build a bridge from prior year or budget, quantifying each driver and checking whether the impact is temporary or structural. For example, a higher premium product mix may offset packaging inflation. I would then connect the analysis to actions such as pricing, procurement, portfolio management, or promotional optimization. Mention pricing, product mix, promotional discounts, raw material costs, manufacturing efficiency, freight, currency, channel mix, and accounting classification, with clear bridge analysis from prior period or budget. Question 8. How would you evaluate whether marketing spend is generating an acceptable return? I would evaluate marketing using incremental contribution rather than simply comparing total sales with total spend. I would define the campaign objective, establish a baseline, analyze sales uplift by product and channel, and consider gross margin, timing, repeat purchase, and customer acquisition effects. Where possible, I would use test and control or historical comparisons to improve attribution. I would also distinguish short-term conversion from longer-term brand building, then compare returns with targets and alternative investments. In your answer, cover incremental sales, contribution margin, campaign objectives, timing, attribution limitations, customer acquisition, brand effects, and comparison against targets or alternative investments. Question 9. Tell me about a time you found a significant variance or error in financial data. In a university project, I noticed that reported expenses were unusually high compared with the prior month. I traced the variance to a duplicated import caused by inconsistent transaction dates, then reconciled the source file to the ledger and quantified the correction. I explained the issue clearly to the project lead, corrected the report, and added a duplicate check formula before future uploads. The experience reinforced that strong FP&A work combines analytical curiosity, control discipline, and clear communication. Use a clear situation action result structure, explain how you investigated the issue, validated the root cause, communicated professionally, corrected the output, and improved the process to prevent recurrence. Question 10. Which Excel tools would you use for FP&A analysis? I would use XLOOKUP or index match for controlled data retrieval, SUMIFs for driver-based aggregation, and pivot tables for fast exploration. Power Query would help standardize recurring files, while charts and bridges would make management insights easier to understand. For forecasting, I would separate inputs, calculations, and outputs, add error checks, and use scenario tables for sensitivities. I avoid unnecessary hard coding and document key assumptions so another analyst can review and update the model confidently. Mention formulas, pivot tables, Power Query, data validation, scenario tools, charts, checks, and model structure, while emphasizing accuracy, transparency, scalability, and avoiding hard-coded outputs. Question 11. How would you use Power BI or another dashboarding tool in FP&A? I would use Power BI to automate recurring reporting and give stakeholders a consistent view of sales, margin, expenses, and forecast performance. Before building visuals, I would agree on KPI definitions, data ownership, refresh frequency, and the decisions the dashboard must support. I would create drill downs by brand, market, channel, and product, then validate totals against the ledger and approved reports. Automation should reduce manual work, but commentary is still needed to explain why performance changed. Focus on defining decision-useful KPIs, connecting reliable sources, creating consistent dimensions, enabling drill downs, validating outputs, and balancing automation with management commentary. Question 12. How does FP&A interact with accounting during the month-end close? Accounting establishes accurate actuals through the close, including accruals, provisions, reconciliations, and correct classification. FP&A then validates whether the results align with business activity, compares them with budget and forecast, and explains the implications. I would maintain a close calendar, investigate unexpected movements quickly, and coordinate with accounting when an entry or allocation appears incorrect. Timely collaboration matters because a late correction can affect management reporting, variance analysis, and the next forecast cycle. Explain the distinction between accounting ownership and FP and interpretation, including accruals, reconciliations, actuals validation, reporting deadlines, close adjustments, and forecasting implications. Question 13. How would you analyze inventory and working capital performance? I would analyze inventory through turns, days on hand, aging, obsolescence risk, service levels, and forecast accuracy. I would also review receivable days, payable days, and the overall cash conversion cycle. For L'Oréal, excess inventory can tie up cash and create write-down risk, while insufficient stock can hurt sales and retailer relationships. I would investigate variances by product and market, connect them to demand and supply assumptions, and recommend actions such as replenishment changes or slow-moving inventory plans. Be sure to cover inventory turns, days on hand, obsolescence, service levels, receivables, payables, cash conversion, demand assumptions, supply constraints, and trade-offs between cash and product availability. Question 14. How would foreign exchange affect L'Oréal's forecast and performance analysis? Foreign exchange can affect transaction costs, translated revenue, translated profit, and the comparability of forecasts across markets. I would separate reported growth from constant currency growth and clearly identify whether a variance comes from rates or underlying operations. In the forecast, I would document the exchange rate assumptions and run sensitivities for major currencies. I would also coordinate with Treasury and local finance teams, ensuring management does not mistake translation volatility for a change in consumer demand or commercial execution. Discuss transaction and translation effects, constant currency analysis, rate assumptions, hedging where relevant, local versus group reporting, and separating operational performance from currency-driven movement. Question 15. Describe a time you had to explain financial information to a non-finance stakeholder. I once explained a project cost overrun to a team member who was unfamiliar with financial reporting. Rather than discussing accounting categories, I showed the original plan, actual spending, the three main drivers, and the remaining budget using a simple chart. I then linked each driver to a practical decision and invited questions. That approach improved understanding and moved the discussion from assigning blame to managing the outcome. In FP&A, clarity is as important as technical accuracy. Emphasize simplifying technical concepts, leading with the business implication, using visuals or examples, checking understanding, and tailoring the message to the stakeholder's decision and level of financial knowledge. Question 16. What would you do if the latest forecast showed that a business would miss its target? I would first verify the data, assumptions, and timing to ensure the shortfall is real rather than a reporting issue. Then I would quantify the gap and identify the drivers, such as volume, pricing, mix, supply, or spending. I would discuss realistic actions with commercial and operational owners, model their financial impact and present base, downside, and recovery scenarios. I would escalate early with a clear recommendation while maintaining forecast integrity instead of forcing numbers to meet a target. Cover validating the forecast, identifying root causes, quantifying the gap, escalating early, developing realistic corrective actions, updating scenarios, and avoiding unsupported optimism or last-minute surprises. Question 17. Which KPIs would you prioritize for a beauty and consumer products business? I would prioritize net sales growth, volume, price, mix, market share, distribution, sell-in, sell-out, gross margin, and promotional ROI. For innovation, I would track launch timing, distribution, repeat purchase, and the percentage of sales from new products. Operationally, inventory availability, working capital, and cash conversion are important. The right KPI set depends on the decision. A brand manager may need campaign and consumer metrics, while a CFO needs profitability, forecast accuracy, and cash implications. Mention revenue growth, volume, price, mix, market share, sell-in and sell-out, gross margin, promotional ROI, distribution, innovation, inventory, and cash conversion, tailored to management objectives. Question 18. How would you assess the financial impact of a price increase or promotional campaign? I would model the change through volume, gross price, discounts, mix, and contribution margin. For a price increase, I would estimate elasticity, competitive response, customer segmentation, and the possible effect on units and market share. For promotion, I would compare incremental volume with discount cost, retailer funding, cannibalization, and post-promotion demand. I would build scenarios and evaluate profit, not just revenue. The recommendation should reflect both immediate economics and the brand's longer-term positioning. Discuss volume elasticity, net price, mix, cannibalization, retailer support, margin contribution, competitor response, timing, and scenario modeling rather than relying on revenue impact alone. Question 19. How would you handle pressure from a stakeholder to adjust a forecast without evidence? I would listen carefully to the stakeholder's rationale and ask which operational evidence supports the requested change. If the assumption is credible, I would update the model transparently and document the source. If it is only an aspiration, I would keep the unbiased forecast intact while showing a separate upside scenario or target case. I would explain the consequences clearly and escalate respectfully if necessary. Reliable forecasts require constructive challenge. They should inform decisions, not simply confirm desired outcomes. Focus on integrity, asking for supporting assumptions, distinguishing targets from forecasts, documenting changes, offering scenarios, escalating appropriately, and preserving a transparent audit trail. Question 20. A L'Oreal division has strong sales growth but declining profit. How would you investigate? I would start by reconciling sales and profit trends, then build a bridge separating volume, price, mix, discounts, cost of goods, marketing, logistics, overhead, foreign exchange, and one-time items. Strong growth may be coming from lower margin channels, heavily promoted products, or inflation-affected categories. I would analyze performance by brand, market, product, and channel, validate drivers with business owners, and test corrective actions. Recommendations might include pricing, mix improvement, promotion discipline, sourcing, or reallocating marketing. Include a structured bridge across price, volume, mix, discounts, product costs, marketing, logistics, currency, overhead, and one-offs, followed by targeted management recommendations. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.